What makes certain currency pairs more popular and lucrative than others? How do economic indicators and geopolitical events influence currency values? Have you ever wondered why the euro versus the US dollar pair is often referred to as the king of currency pairs? Well, you will find answers to all these questions in today's tutorial. Hello friends, welcome back. Today we have an exciting topic to delve into: CFD instruments. We'll be covering everything from currency pairs to CFDs for stocks, stock indices, commodities, and cryptocurrencies. If you're new here, don't forget to hit that subscribe button and the notification bell so that you never miss out on our trading lessons. To begin, let's grasp the concept of Forex currency pairs and delve into their operational dynamics. In Forex trading, a currency pair represents the comparative value of one currency against another. It's like a dynamic duo of currencies. Each pair consists of a base currency and a quote currency. Here's where it gets interesting. When you buy a currency pair, you're essentially purchasing the base currency while selling the quote currency. On the flip side, when you engage in selling a currency pair, you are selling the base currency and, in return, receiving the quote currency. You know you're a hardcore Forex trader when you see a romantic couple, and instead of love in the air, you smell Australian dollar, New Zealand dollar volatility. All right, let's get back to the tutorial. These currency pairs are categorized into three main types based on their trading volumes. First, major currency pairs. Second, minor currency pairs. Third, exotic currency pairs. Let's try to understand these pairs more deeply. So let's talk about major currency pairs. Well, they are the most traded ones. They come with tight spreads, making them popular among traders. They include EUR and USD, the euro versus the US dollar, USD and JPY, the US dollar versus the Japanese yen, GBP and USD, the British pound versus the US dollar, CHF, USD, the Swiss franc versus the US dollar, AUD and USD, the Australian dollar versus the US dollar, USD CAD, the US dollar versus the Canadian dollar. Among these giants, there's one that stands out as the most liquid and widely traded: the euro versus the US dollar. But what does that mean? Imagine the euro versus the US dollar with ask and bid quotes at 1.08842 and 1.08840 respectively. In this case, the euro is the base currency and the US dollar is the quote currency. This means that you can buy the currency pair for 1.08842 US dollar and sell it for 1.08840 euro. That's how these pairs work, and the prices move constantly. Here's a fun fact for you. The Australian dollar versus the US dollar and the US dollar versus the Canadian dollar pairs are known as commodity currencies. Do you know why? Well, both Australia and Canada are rich in commodities, and their currencies are influenced by changes in commodity prices. It's like trading a piece of their economic landscape. But what really sets the major currency pairs apart from the rest? The answer is liquidity. But what exactly is liquidity? Liquidity refers to the degree to which the Forex market can handle buy and sell trades without causing significant shifts in exchange rates. It's like a bustling marketplace with countless buyers and sellers for these currency pairs. So now that you're familiar with major currency pairs, can you tell me what Forex traders and weather forecasters have in common? They both make predictions, but Forex traders deal with currency clouds. So you've learned about the majors, but what about the minors? Well, minor currency pairs aren't tied to the US dollar, which gives them a unique identity. The markets for these pairs might not be as liquid as those for majors, and their spreads are slightly wider, making them moderately liquid for trades. Some of the currency pairs with the highest trading volume are those where the individual currencies are also majors. Examples include Euro to Great British Pound, Great British Pound to Japanese yen, and Euro to Swiss franc. My friend dated a Forex trader once. It was like being in a relationship with Great British Pound to Japanese yen. One minute, it's all love, and the next, it's a messy breakup. All right, now let's talk about the exotic currency pairs. They're like the thrill seekers of the Forex world. Exotic currency pairs feature currencies of developing countries. However, they come with a different set of rules. Exotic pairs are less liquid, and their spreads are much wider. Think of them as the daredevils of the Forex world. Examples of exotic pairs include the US dollar to South Africa rand, US dollar to Russian ruble, and US dollar to Thai baht. These pairs may not have the same trading volumes as the major and minor pairs, but they bring something exciting to the table. Want to know what? Trading exotic currency pairs offers the potential for higher volatility, diversification, and potentially greater returns, but it comes with increased risk due to lower liquidity, wider spreads, and the need for specialized knowledge of the involved currencies and economies. Careful risk management is essential. Shares CFDs. You've probably heard of trading shares in companies like Amazon, Alphabet, Meta, Tesla, and Apple. When you buy shares of a company, you own a piece of that company and get voting rights. It's becoming a shareholder and having a say in the company's decisions. But what about shares CFDs? Well, in this world, it's a bit different. When a trader opens a position of shares CFDs, they're not actually buying the shares. Instead, they agree to trade the difference in price of the company's shares between when they open and close the trade. They don't own a piece of the company or have voting rights. Shares CFDs are traded in the currency of the country that hosts the stock exchange they are listed on. For example, if a shares CFD is listed on NASDAQ, it will be traded in US dollars. Now let's shift our focus to stock indices. These are like a window into the broader stock market. The most popular stock indices include the S&P 500, Australian 200, NASDAQ, Dow Jones, and the Financial Times Stock Exchange 100. CFDs indices track the value of their respective indices traded on stock exchanges. For instance, the CFD Australian 200 index tracks the price movement of the Australian 200, which consists of the 200 largest firms listed on the Australia Securities Exchange, and it's traded in Australian dollars. The NASDAQ Stock Exchange is a tech-dominated market that tracks the 100 largest and most actively traded US companies, including tech giants like Apple and Microsoft. And the FTSE 100 index tracks the shares of the 100 largest companies listed on the London Stock Exchange, also known as the FTSE. Let's discuss commodities now. Commodities are resources that are either grown, produced, or extracted from the earth. In the trading world, there are 3 types of commodity CFDs, each tracking the price movement of their underlying commodities. First up, we've got energy commodities. The stars of this category are UK oil and US oil. UK oil is based on the Brent price, while US oil follows the WTI price. These two are like the heartbeat of the energy sector. Now let's talk about agricultural commodities. This includes CFD contracts based on raw goods like sugar, cotton, coffee beans, and more. These commodities play a significant role in the global market and can offer unique trading opportunities. The third type is metal commodities. You've probably heard of gold and silver, right? They're the heavyweights here, but it doesn't stop there. We also have copper and platinum. These metals are pivotal in various industries and, of course, in CFD trading. Now let's talk about the safe haven of the trading world, gold. This is like the timeless classic that never goes out of style. Gold is valuable because of its limited supply. It's a store of value and a shield against inflation. If you're not into gold, you can consider silver and other metals. They often move in the opposite direction of stocks and bonds, making them the go-to option when markets are in turmoil. Next up, we've got oil. Often referred to as black gold, it's a vital global commodity used in various industries, including energy, transportation, and plastics. The oil market is highly volatile, and trading oil as CFDs can be a way to profit from its price movements. Trading oil involves buying and selling oil-related CFD instruments with the aim of making a profit. UK oil and US oil are the stars in this arena, acting as global benchmarks for energy prices. It's a dynamic and essential part of the trading world. Cryptocurrencies. Now let's move to the digital age where cryptocurrencies are the new cool kids on the block. Trading cryptocurrency CFDs through a broker is like a hassle-free way to jump into the crypto world. No need to deal with digital wallets or cyber wallets. Cryptocurrencies are like rock stars, and they're quoted against two of the world's top currencies, the US dollar and the euro. Some of the most commonly traded crypto CFDs include Bitcoin, BTC and USD, Ethereum, ETH and USD, Bitcoin Cash, BCH and USD, and Litecoin, LTC and USD. Let's wrap things up with a real-life scenario. Imagine you're in the Bitcoin game. You see Bitcoin recovering from a recent price crash, but you're not sure if the rally will last. So you decide to short sell one lot of Bitcoin USD trading at $36,010, hoping it'll drop to $35,000. To play it safe, you set a stop loss order at $36,300. Scenario 1, Bitcoin keeps going down. It hits your target of $35,000. You initially sold it at $36,010 and bought it back at $35,000, making a profit of $1,010. In scenario 2, Bitcoin's price rises, surpassing its stop loss level of $36,300. You initially sold Bitcoin USD at $36,010 and bought it back at an elevated price of $37,000, resulting in a loss of $990. Understanding the different types of CFDs and their unique characteristics is essential for successful trading. We hope this lesson has provided you with valuable insights into CFD trading. If you have any questions, don't hesitate to drop a comment down below.